Okay, welcome to day 9 of our session. Okay, I think I didn't put up the mic earlier, and we are welcoming 2 new participants, and I want you to put up your camera. We do put up our camera in these sessions. Asama Akinfola, please put up your camera. Olufemi Salako, please put up your camera. These are our new participants. Ifechuku was not available last week. Ifechuku, thank you. Please kindly put up your camera. Shegun John, kindly do so as we commence the class. Today is day 9, and we'll continue from where we stopped on day 8. On day 8, we introduce ourselves to various group structures and the introduction to group accounts. And we're able to discuss on the first 2 principles that underline the preparation of group accounts with respect to the consolidation mechanics. Today, we'll continue from where we stopped, and we're going to introduce the 3rd fundamental mechanics or principle for consolidation. And these 3 principles will lay the foundation of what we are going to do going forward. And going back to our discussion, we'll be making use of the material which we have made available to you guys. And for those that have not gotten theirs, they can liaise with me, and they'll get their copies. Okay, I'll share the screen now. Okay, before sharing the screen, this is how far we've gone in the discussion with respect to accounting for business combinations and introduction to group accounts. And where we stopped last week was where we started with the first principle. And the first principle borders on cancellation required in the process of consolidation as a means to producing a single economic concept as an entity. Okay. We also went further to discuss the second principle, which borders on situations where we have a subsidiary that is not wholly owned. Okay, what do we do to the part that is not owned by the parent? And that led us to second principle, which borders on recognition of non-controlling interest as at the date of acquisition. Today, we'll be moving into discussion of the 3rd principle. And that 3rd principle will answer the question that one of our participants asked last week, asking on issues that borders on what happens if you are consolidating subsequent to acquisition. And that will lead us to a new discussion where we need to focus on the reserve of the subsidiary. What do you do with the reserve going forward? And that will lead us to the understanding of why we need to split the reserve into pre-acquisition and into post-acquisition. Okay, and that is that. Okay, I see I wait Ifechuku and Shegun to put up the cameras, and we'll move on. Now, I'll share the screen. And we'll continue from where we stopped. I'll go to chapter 4. Now we are at chapter 4, where we'll be talking about the 3rd principle. Now, what does the 3rd principle signify? It only addresses situation where we are consolidating after the date of acquisition. That is, we are consolidating subsequent to acquisition. And what does that mean? As we move on, you understand that the requirement of IFRS 10 is that at every reporting date, once a parent is still deemed to have control of a subsidiary, the parent should consolidate the account of the subsidiary along with it. And what happened at that point in time is that you produce what we call group accounts, which is a consolidated financial statement. Now, the issue then is, after acquisition, the reserve of the subsidiary will have changed, whether positively or negatively. And why would that be so? Is because it will be influenced by the performance of the entity, which is the subsidiary, since the date of acquisition. What it means is that either the subsidiary is doing well by making profit or is doing poorly by making losses. Which means at one point or the other, this has implication and impact on the reserve of the subsidiary. Thereafter, what happens is that the reserve will now have to be recognized into the component that is pre-acquisition and into the component that is post-acquisition. What do we mean by pre-acquisition? Pre-acquisition means that we are talking about the reserve that constitutes part of the net asset as at the date of acquisition. The reserve that was existing prior to the parent acquiring the subsidiary. Whereas the change, the movement, be it a profit or be it a loss, that impact the reserve from the date of acquisition to today is the element that we consider as post-acquisition. And what does that mean? It means it is a change in the reserve of the subsidiary since the date of acquisition, which is, it is a build-up of the profits or the losses made by the subsidiary after the parent has gained control of the subsidiary. Why do we need to do this? We need to do this because one of the essence why the parent obtain control of the subsidiary is to earn returns from the subsidiary. And once returns are earned by way of the profit that is made by the subsidiary, which gives a positive return to the shareholders. Or the returns are made by the losses accumulated in the subsidiary since the acquisition of the subsidiary by the parent, which give rise to negative returns. These returns are what belongs to the shareholders of the subsidiary. And the shareholders of the subsidiary in this case are categorized or grouped into two. Namely, the parent, which is a controlling interest, and every other shareholders that are collectively grouped as the non-controlling interest. Therefore, this return have to be attributed to the parent and to the non-controlling interest, which then means that this return do not constitute part of the net assets as at the date of acquisition because these are returns generated after the acquisition. Thereby, such return have to be apportioned or shared to both the parent and the non-controlling interest in the proportion they have agreed to share profit or loss, which usually is based on the proportion to which they have stake in the equity of the subsidiary. Invariably, what happens at that point in time? The portion of the returns that is attributed to the parent will be considered as part of the consolidated reserve of the group because the parent is responsible to accumulating the reserve for the group shareholders, which then means that going forward, the reserve to be shown in the group position or financial position will be that of the parent as a standalone business and what is due to it from the subsidiary as a standalone business. This together is what we consider as consolidated reserves. Whereas the portion that belongs to the non-controlling interest will have to be used to effect changes in the value attributable to non-controlling interest, or because the value of non-controlling interest will equally change over time from what it was as at the date of acquisition based on the performance of the subsidiary subsequent to acquisition. Which means if it is a profit that is derivable from the subsidiary, a portion of it that belongs to the non-controlling interest will add to the value of the non-controlling interest since acquisition, and thereby the value increases in amount. Whereas if it is a loss position, the portion attributable to non-controlling interest depletes its value since acquisition and thereby reduce the amount of non-controlling interest as at the reporting date. How do we do this? That is what we need to expose ourselves to in the third principle. And in order to discuss the third principle, what we are going to do is that we are going to look at an exercise that will give us a leeway to appreciating and understanding what is required by the third principle. Before we go into that, I want Olubukola as Olubumi Salako as one of our new participants. You are going to do me this favor. I'll enlarge it. You are going to read the third principle, which will corroborate some of the explanations I've given. And on that premise, you have the right to unmute and read at this point. Thank you.
Okay, sir. Consolidation subsequent to acquisition and accounting for pre- and post-acquisition reserves in group accounts. In calculating goodwill upon acquisition or gains from a bargain purchase, pre-acquisition reserves is taken into consideration in determining the fair value of the subsidiary net assets acquired, while post-acquisition reserves will be added onto the parent's retained earnings in bracket reserves in ascertaining the consolidated reserves in bracket consolidated retained earnings. Pre-acquisition profits are profits or losses of a subsidiary made and undistributed, that is retained, before the date of acquisition, and these profits or losses are a component of the net assets that exist in the subsidiary as at the date of acquisition. Example, if a subsidiary called Ava PLC is acquired on January 1, 2015, when its profits/reserves stood at 20 million naira, then the sum represents its pre-acquisition profits, which already is part of its net assets as at the acquisition date. Post-acquisition profits are profits or losses made subsequent to or after the date of acquisition. These profits or losses will have arisen whilst the subsidiary was under the control of the parent company, and these profits or losses will be reported through the consolidated statement of profit or loss and other comprehensive income, which end up in the consolidated retained earnings in the consolidated statement of financial position. Example, given that the reserves of Lily PLC stood at 20 million naira upon acquisition on January 1, 2015, and as at the reporting date subsequent to acquisition on December 31st, 2015, the reserves stood at 30 million naira. Hence, the post-acquisition profits will stand as 10 million naira, being an increase in reserves to 30 million from 20 million naira. In another case, if the reserves as at December 31, 2015. December 31, 2015 had been the sum of 15 million, naira. The post-acquisition reserves would have been a loss of 5 million naira, being a decrease to 15 million from 20 million naira.
Okay, thank you at that point. Thank you on that point. Now, let us try and analyze it. I'll give us scenarios, and we're going to discuss this scenario one by one. The night today is Saturday, 13/2021. Scenario 1, reserve at acquisition was 20 million, and reserve today, 2 years after, stood at 8 million naira. Scenario 2, reserves at acquisition, I think, okay, I'm not sharing that. Let me share that to you so you see what I'm writing. Reserve at acquisition was 20 million, and reserves today, 2 years after, stood at negative 5 million, which means negative 5 million means accumulated loss. Scenario 3, reserves at acquisition was negative 10 million, and today the reserve, which was 2 years worth after, stood at negative 2 million. Scenario 4, reserves at acquisition was negative 10 million, and reserves as at today, 2 years later, stood at negative 12 million. Okay, I want each volunteer to pick it one by one. What I need from the volunteers What I need from the volunteers are as follows. I need you to give me the pre-acquisition reserve, and I want you to give me the post-acquisition profit or loss. In each of the case, pre-acquisition reserves and post-acquisition profit or loss. Pre-acquisition reserves, post-acquisition profit or loss. Pre-acquisition reserves, post-acquisition profit or loss. Okay. Please, if you are to volunteer, unmute and let's answer it in the order of the scenarios. Nudin, I think you have muted. Okay.
Yeah. For scenario 1, our pre-acquisition reserve will be 20 million, while post-acquisition reserve will be 28 million.
Can you justify why?
Because as at the date of acquisition, the reserve stood at 20 million, while 2 years after the acquisition, the reserve stood at 8 million.
What is now the post-acquisition reserve? What is the post-acquisition reserve?
Oh.
First, what do we consider as post-acquisition reserve? Who can explain, not the answer now, what constitutes post-acquisition reserve based on our simple explanation? Asama, okay.
So I think post-acquisition reserve is the change that occurred after the date of acquisition. After the date, any change, it could either be a profit or loss that occurred after the date of acquisition.
On that premise, can you assist us to continue with that scenario 1? There's no argument about reserve at acquisition, okay? But we are told that post-acquisition profit or loss, what is it as of today?
So as of today, 2 years after, I think the post-acquisition loss is 12 million.
Okay, thank you. Okay, therefore, on that premise, can you assist us to answer scenario 2 before another person takes it up on you?
Scenario 2, reserves as at acquisition date is 12 million, and today is stood at 50 million. So,
million. Reserve as at acquisition. Sorry? The reserve as at acquisition in scenario 2 is 20 million. Why as at today is 5 million negative? I'm talking of scenario 2.
So, okay, pre-acquisition reserve for scenario 2 remains 20 million, while the post-acquisition profit or loss for scenario 2, loss will be 25 million loss.
Okay, can you explain why?
If I'm correct.
Explain why. How do you get 25?
Because as at the acquisition date, which is the cutoff date, we have a profit in reserve of 20 million. But after 2 years of pre-acquisition, we realize that even we have exhausted our 20 million profit and we have gotten into a 5 million loss, which shows that we have lost more than our previous reserve. So it will be in negative now.
Losses in 2 years is so much that it has eroded the entire 20 million we made. And it didn't stop at that. It still went further to give additional 5, which means all in all, we have lost 25 million in 2 years. Okay, who will take over scenario 3?
Can I go ahead?
Yes, sir.
Yeah, pre-acquisition reserve is 10 million loss, like we have it, while the post-acquisition reserve will be 8 million profit.
Acquisition is 10 million loss.
Yes.
While post is what?
8 million profit.
8 million profits. Can you explain it, sir?
Yes, because we have made extra 8 million to bring down the accumulated loss as at acquisition down to 2 million. It takes us to.
What it simply means is that you make a loss position. Even though today you are still in loss position, but you have improved so that the loss position has reduced from 10 to 2, which means you have performed to the extent of 8 to bring it down to 2. Thank you, sir. Who will look at the last scenario for us to proceed?
I would like to look at it.
Okay, sir.
Okay, the pre-acquisition reserve is 10 million loss, while the post-acquisition loss will be 2 million.
10 million loss
for the pre-acquisition reserve.
And what would be the post-acquisition loss?
2 million.
Can you explain it, sir?
Yeah, because the company was in a loss position as at acquisition of 10 million, and the loss had further increased to 12 million. So that means it has sustained additional loss of 2 million.
Thank you very much, sir. Thank you very much, sir. Okay, thank you. That is what we are trying to, that's what we are trying to achieve. Okay, that is good. Now, as basic as it is, it creates problem for people, especially when there's a swing from profit to loss, loss to loss, loss to profit. And that's what I just tried to explain with this scenario. And I believe your understanding of this scenario will bring it home. Therefore, how does this affect our consolidation? One thing is to know how to split. The second thing is, what is the implication of this split and what treatment do we accord each one of them? Now, to do that, I'm going to more or less cut off I'll cut off this question and I will put it on our notes so that somebody can volunteer to read. And from there, we try to attempt solving the problem. Okay, this is a problem before us. And what we need to do is to consolidate this account based on this information as at this date, whereas this was the date of acquisition. Okay. Who will volunteer to read the question?
Okay, I'll read.
Can I go ahead?
Yes, sir. You can go ahead, sir. We can't hear you, Mr. Shek. Okay, or Asama. Okay, go ahead.
Arsenal acquired 70% of the ordinary shares of Manchester United on 30th June 2015, when the balance in the later retained earnings stood at 30,000 naira. So the statement of financial position as at 30th June 2016 now reads, Non-current asset for Arsenal, 500,000. Manchester, 240. Investment in Manchester, 196. Current assets, 140. Share capital and reserves. Equity share at €1, have 250. Reserve. Retained earnings 186, while Manchester have 50. Current liabilities. Arsenal's current liabilities is 50, while Manchester has instructions, sir.
Okay, no, that's why at the beginning I've said we want to consolidate. Okay, and we are consolidating as at this date, whereas we acquire on this date. The question then is, what is the gap between these 2 days? 1 year has passed. Abi? Does that make sense? Now, remember, Arsenal acquired 70% stake in Man U, and the whole stake in Man U should be 100%, which means he has given NCI what stake? 30%. Because 100 plus 30 make up, 70 plus 30 make up Man U as 100%, a whole. 100% means 1, which is a whole. Therefore, what do we do in this case? What we do is to ensure that, okay, we have the reserve of Manchester United as at today, which is 30th June 2016. What was the reserve? 50, Abi? It is 50 million. This 50 million have to be splitted into 2. Into what it was as at 30th of June 2015, which was the date of acquisition, which means what we have here is pre-acquisition reserve. And what is our pre-acquisition reserve? If we go by the question, as at 30th June 2015, when Arsenal acquired stake in Manchester United, the retained earnings stood at how much? 30,000 naira. Therefore, if that is the case, I come here to say my pre-acquisition is how much? 30,000 naira. But today, the reserve is 50 million. Therefore, what is my post-acquisition profit? What is my post-acquisition profit? Who can answer that? What is my post-acquisition profit?
20.
Is how much?
20 million.
20 million. No, 20,000. All figures are in thousands. Okay. Is that clear to everyone? Okay. Therefore, what do we do? Let's go back. Remember our principle of cancellation. First principle. What is first principle? Cancellation. What do you want to cancel out? By this first principle, we first of all identify what is our cost of business combination. And we'll now compare that with the net assets of Man U as at acquisition date. These two things are what we compare together. And we are aware of the following. What makes up cost of combination is one, ACCA's investment in Manchester United. And two, non-controlling what? Interest what? Investment. In Manchester United. Now, what is ACCA's investment in Manchester United? ACCA invested how much? 196. How do we arrive at this 196? We are going to see that later as we move on in this program. Now, what is NCI's investment? We'll come back to that. But before then, what constitutes our net assets? If you remember our discussion here, at the beginning of our program, starting from the issue of the accounting equation, we said our net asset comprises of share capital and reserve, which is the process we cancel out. Why on the left-hand side is where we have the assets and liabilities that we consolidate. Therefore, on that premise, what do? I come here with my share capital. Of Man U, which is what share capital of Man U? The share capital of Man U is 250. And with the reserve of Man U as at the date of acquisition, which means with the pre-acquisition reserves of Man U. And what is that in this case? That is what we have here.
30,000.
30,000. Because this two is what constitutes 280,000 that was the net worth of Man U as at the date of what? Acquisition. Therefore, remember, in our discussion, we said, how do we measure non-controlling what? Interest under second principle. Under second principle, we said non-controlling interest let me annotate it so that I can see it. Non-controlling interest is accounted for at acquisition date based on what? The proportionate share of the non-controlling interest in the value of the subsidiary's net asset as at the acquisition date. And what is the value? Is the net asset, which is made up of share capital and reserve as at the date of acquisition, where we find our stake, which is the proportionate share. In this scenario now, what is our proportionate share? Our proportionate share is 30%. Remember this percentage, 30% of this 280. And what is 30% of 280? I believe we all have our calculators. It's 84. $84 plus 196 will give us cost of combination of 280. Now, our principal unveil itself. 280 cancel 280, which give us what? Is 0. Now, this is the third time we are canceling out and it's nearly off. Is this how it will continue? Maybe, maybe not. But as time progresses, certain principles will be unveiled. Okay, remember our second principle is about accounting for non-controlling interest. Now, though we have accounted for non-controlling interest, but the value for non-controlling interest will change as at today, because today is now 30th of June, 2016. Remember, the value we had here was as at 30th of June, 2015, which was the date of acquisition. Now, what is our value? NCI value will first be taken into consideration from the date of acquisition, which was 2015. At what amount was it? At 84. Now, don't forget, this 20,000 is considered returns to shareholders of who? Manchester United, Man U. And who are the shareholders of Man U? The shareholders of Man U are who? Arsenal and non-controlling what? Interest.
Arsenal and NCI.
Yeah, NCI, yeah. Now, what is the stake of Arsenal? 70%. What is the stake of NCI? 30%. Which that means that NCI will now take 30% of the post-acquisition profits, which in this case is 30% of 20,000. And that should give us 6, which means performance of subsidiary will affect non-controlling interest, whether positively or negatively. Now, the third principle, which is a key reason why we are here, is that we need to account for consolidated reserve. This is second principle. Third principle. Accounting for consolidated reserves as at the reporting date. And what is that? It is reserve of Arsenal as a standalone business, which we have here as 186, plus similarly what we have here, share of what? Post-acquisition profits, which is 70% of 20,000. That give me 14. All in all, that give me 200. Now, that is what we try to establish as the third principle. And that is the reason why we split this reserve into pre-acquisition and post-acquisition. Now, let's present our balance sheet and let's see as it looks. What I'll do is that I'll copy the balance sheet upward here to create efficiency and just change the figures. So that it will not make me waste time in copying. Okay. Therefore, I can easily clean up what is not. Okay. Now, you know, we are in the age of technology. You need to be more efficient. Instead of repeating things, there are ways to which you can create more efficiency. Now, the group in this case is Arsenal Group. And we are reporting as at 30th June 2016. Okay, for ease of navigation, let me just copy this again and I'll still take it off. And let me just put it on the side here so that we can capture it at a glance. You know, we are in the world of technology where you need to be smart. Where people are using 10 hours to do something, you can use 10 minutes to do that same thing. And that's where the value sits. Now, the PPE now, in this case, is 500 and 240. Which is 740. Investment has been cancelled out. Can you remember? What is left is current assets, 140 and 180. And that gives me what? 320. Invariably, I have 1060. Share capital. Remember, that of Man U has been cancelled out. What is left is that of the parent, which is Arsenal, 600. Reserve has been cancelled out. What is left is the parent, but because part of this 50 was not cancelled out, but was rather taken as a return, taken as what? A return to shareholders of Man U, of which 70% has come here. And yeah, we are now substituting 186 for 200. We are substituting 200 for 186. Therefore, in that case, this went off. I wrongly deleted it, this 600. We are now substituting consolidated. which is 200. That give me what? 800. That is still equity attributable to shareholders of Arsenal. Okay, let me save that. Now, what is the amount of non-controlling interest? Non-controlling interest has moved from 84 to 90 because of this profit. Therefore, non-controlling interest as a reporting date is now 90. 6,000 higher than what it was at acquisition. And what is my current liability? 50 and 120. And that gives me 170. When you add it together, you have this. Does it make sense now? Does it make sense now? Any contribution, question, or otherwise? I wait. Nuruddin, any contribution?
Yes, sir. Actually, I was following as you are taking a step-by-step approach to solve the solution, to solve the question. And it is well presented and very straightforward and easy to understand. That's what I observed, sir.
Okay, thank you. Any other question? Akinfolai, what's your view as a newcomer?
Yeah, I quite understand the step-by-step presentation. I didn't really grab the first and second principle, but I understand the third principle in accounting for consolidation reserve. But by the time I catch up on the first and second principle, I know, I think it's straightforward. I understand, sir.
I think I told you yesterday that as a prerequisite to participating today, you should have watched the video for the 7.
Yeah, I started it already, but I couldn't. I didn't get to the principles. Thank you, sorry, sir.
That means you have opportunity to look at it. But again, the principles are clear.
Yes, very clear.
Olubunmi Salako, new participants, also I want to hear your view. And I can't see your face again.
Sorry, sir, I'm swallowing small rice.
Okay. I don't want us to salivate, okay.
So it's very explanatory, very straightforward.
Were you able to look at the section that precedes this, the videos, before you join us at this middle point?
Not yet, sir.
Okay. Now let's look at, I'm going to put up a problem to you guys, and I'm going to give you time to peruse it. Okay. I'll give you these questions, and I want you guys to deliberate on it for the next 10 minutes. And I'll make Segun John to be the anchor. I want you guys to, Segun will anchor it, and I want you guys to participate effectively for 30 minutes, for 10 minutes, sorry. And what is it about? I'm sharing the screen now. I want to see whether we really understood what it is we have discussed so far. We've discussed the 3 fundamental principles for consolidation. I believe you can see it clearly. Segun, can you see it clearly?
I can see it.
Okay, you'll be the anchor for the next 10 minutes. And I want us to be fast as practicable. We need to answer these questions. And we'll now consider whether we are on track, because the foundation are what we have just laid down between last day 8 and now, before we move forward, so that we are to build upon this foundation. And we need to be well assured that this foundation is solid enough for us to start to put on blocks and some other floors on it. Thank you. You can proceed with that. Thank you.
Okay, thank you very much for the opportunity. And we'll start with the first question, which is, what does consolidation entails in the context of group accounts? So I want to make the floor open for anybody who wants to come up with his or her understanding of consolidation. I would like to hear us out. So, who is speaking?
You could call out people.
All right. Madam Grace, what do you understand by consolidation?
Consolidation is a combination of two businesses, where one is a parent and other is a subsidiary with a controlling share. And the parent company prepares a consolidated account.
Okay. So she said consolidation.
Which is a group account.
Okay, yeah. Quite interesting. Who else want to add something to what she has said? She had said something very vital, that is a combination of two accounts between the parent and the subsidiary. But can somebody tell us what actually led to consolidation? Like, what must be present before there can be consolidation?
Okay. Thank you very much, Sego. Okay, I want to contribute, Mr. Shego.
Please go ahead, Nuruddin.
Yeah, in addition to what Mrs. Grace said, consolidation is the combining of businesses, especially combining the accounts of two or more businesses. But before consolidation can take place, the businesses, the two entities, one must be recognized as parents, while the other one must be recognized as subsidiaries. If this relationship does not exist, it means consolidation cannot take effect.
Yeah.
Okay.
Thank you very much.
That is what I want to contribute as regards to consolidation.
Thank you very much. There must be parent-subsidiary relationship that arises as a result of control of parents over the subsidiary. So we move to the second question. How can non-controlling interest be recognized in a wholly owned acquisition of a subsidiary? how can we recognize non-controlling interest in a wholly owned acquisition of a subsidiary? This is a very tricky question, and I want somebody to volunteer to explain his or her view about how we can recognize NCI when it is wholly owned by the parent. Mr. Sunday Ajibola, can you help us out?
Okay, like you said our view. So I want to share my view. I may not be correct, but my thinking is this: that since it's a wholly owned subsidiary,
yes,
then there shouldn't be anything like non-controlling interest. So I would rather say that non-controlling interest should be recognized as zero in a wholly owned acquisition of a subsidiary.
Okay, thank you very much, Mr. Ajibola. Mrs. Oladokun, please, do you agree with what he said? Madam Oladokun. Okay. Let me call one more person before we move on. Abolade, do you agree with what he said? All right. There cannot, my own view is that we cannot have non-controlling interests in a situation whereby the parent owns the 100% of the equity share capital of a subsidiary. So there wouldn't be anything like non-controlling interest. That is my view. So we move to the third point. How can a non-controlling interest be described? Can somebody volunteer to explain the non-controlling interest vis-a-vis what we have been taught so far since last week till today? What do we understand by non-controlling interest? Mr. Akinfolarin, can you try?
Yeah, let me try this. So a non-controlling interest in business acquisition is the portion of the interest, either equity or of the interest in the company of the subsidiary not acquired by the parent.
Okay.
That's the description I have. I may not be, but I think that's it. Thank
you. As far as I'm concerned, I think you have said the right thing, but if someone else want to paraphrase it or phrase it in a different way, I will really appreciate if somebody want to phrase it differently. But I think it's correct, but you might want to phrase it in a different way. Nurudin, can you say
Okay. Actually, based on what the first speaker said, I share the same idea that a non-controlling interest is the proportion of shares that is not belong to that the parent has no control over, meaning that the parent subsidiary relationship is not inclusive of non-controlling interest. However, when a parent has a proportion of shares, the one that the parent has no control over is what we regard as non-controlling interest.
Okay, thank you very much. In a nutshell, it's just the proportion of the equity share capital of a company that does not belong to the parents, belong to other investors in the business. So we go to the fourth question. Why the cancellation of the fair value amount of both the equity investment in the subsidiary and the subsidiary's acquisition date net asset? Why the cancellation of the fair value amount of the equity investment in the subsidiary and the subsidiary's acquisition date net assets. So why do we need to cancel between the net assets and the equity investment in the subsidiary?
Can I say something? Hello? Hello?
Go ahead.
Okay, I think the reason for cancellation of the fair value amount, both the equity investment and the subsidiary and subsidiary acquisition date net assets, is to actually cancel out the portion of shares acquired by the parents in order to avoid double counting when a group account is being presented by the parents. However, since the parents will recognize the group equity share capital, the consideration made by the parents as at the acquisition date to the subsidiary net assets has to be cancelled out in order to avoid double counting effects. That is my take as regards the cancellation principle.
Olubumi, do you want to say something? Okay. Enaoro, do you want to say something about why we need to cancel out the equity investment in subsidiary and the subsidiary net assets?
Yes, I think we need to cancel them because both of them, they represent it is for consolidation. You find out that the payment was meant for the net asset. So what was paid is meant for the net asset. So we actually buy the net asset of the parent is buying the net asset of the subsidiary. So that is why if you take two of them together, I think it will be an in and out thing. Just like, so it's an in and out thing. So basically you cannot take two of them. There's a word I'm trying to remember. It's by just like one is owing the other one. One is, it's like the parent, it becomes an asset and liability for the parents. So if you consider the two of them, for instance, the equity, if you don't remove it, it becomes a liability and the asset becomes, there's a word I'm trying to remember there, but you have to remove them because that's what you're buying actually.
Okay, it's all right. In my own view, I think the essence of the cancellation is to know whether is to know the difference between what the parent and the NCI are paying for the acquisition of a company and what is the value of the net assets of that company as at the date of acquisition. Then that will enable us to know whether it's going to lead to a goodwill or possibly a gain in bargain purchase. So that is just my idea about that. And I believe Mr. Olumuyiwa will help us shed more light on it later. So we move to the next question. This is question 5. Distinguish between pre-acquisition reserve and post-acquisition reserve and the accounting implication at the acquisition date. Asama, do you want to try? Who have I not called? Maybe I have not called some people.
Okay.
Okay, please
Hi,
hold on. Let me call someone else, please. I want to call someone that have not spoken. Olawale. Olawale. Okay. Abolade.
Very much. Pre-acquisition, the pre-acquisition reserves are the reserves that is existing before the acquisition date. While post-acquisition reserves are those reserves that are existing after the acquisition date.
Okay, what is their implication as at the acquisition date?
The pre-acquisition reserves, the accounting implication of as at the acquisition date. Hello?
Yes, I'm listening.
Can you hear me?
Yes, I can hear you.
Okay. So actually, I lost this thing. My network was very bad when they are trying to explain that.
Okay.
The fair idea of what I could use was that those acquisitions, those results that are existing before the acquisition date.
Okay, so right. Madam Grace.
That are existing after the year.
Okay, Madam Grace. He has clearly explained what pre-acquisition and post-acquisition reserve means. But can you now tell us the implication of pre and post-acquisition reserve as at acquisition date? Hello? Madam Grace, can you hear me? Okay, if I can just say something about that.
Okay.
If I can say something about that, the pre-acquisition reserve is very important in arriving at the net assets of the subsidiary as at acquisition dates, because it's going to be added to the share capital of the subsidiary, and the total is what we net off from the fair value of equity investments of the parent and NCI. Or maybe somebody wants to say something contrary to what I've said. Yeah, because of our time, we move on.
I actually want to share the same idea with your expression.
Okay.
And my take on the accounting implication of pre-acquisition reserve is that it will form part of identifiable net assets of subsidiary at the date of acquisition.
Okay, thank you very much. So
how about the post?
Post-acquisition will have effect at the date of consolidation.
Yes, the reason why I didn't ask us to talk about post is because the question says, and their accounting implication at the acquisition
date
date.
Of acquisition, exactly.
So I don't think we need to bother ourselves too much about the accounting implication of post-acquisition reserve as at acquisition date. So the number 6 now, IFRS 3 does require the net off or cancellation of both equity investments in the subsidiary and the subsidiary acquisition date net assets. What is the essence? Who wants to help us? I also want to learn, please. Who wants to help us? has not spoken.
But that is related to, sorry, I just want to look at it. That was related to question 4. Is, I think it's the same answer, or they should have the same answer. That's my take. Question 4 and question 6 are the same thing.
Okay, so what is the answer? You can still repeat what you think.
Mr. Shegun, I think in accordance with IFRS 3,
okay,
the reason for net off or cancellation is to prepare a group account as if the entity is one. And I think that's what IFRS 3 categorically spell out with respect to net off or cancellation of equity investments in the subsidiary and the subsidiary acquisition date net assets.
okay. I will not give any additional comment on that. We move to the next question. Can a conclusion be reached that the cancellation of both the equity investment in the subsidiary and the subsidiary's acquisition date net assets perfectly offsets or net off? Can a conclusion be reached that the cancellation of both the equity investment in the subsidiary and the subsidiary acquisition date net asset perfectly offsets or net off? Do we all understand the question?
Mr. Hello, I agree that it perfectly offsets. As I said before, it perfectly offsets because both of them, they have to do with, it's a net off, basically. It's a net off. You can't owe yourself. So you can't owe yourself. So basically, you just have to net off both the whatever you stage, the investment, and also the net asset of the subsidiary. So that is my own take, as my humble take.
Okay. Number 8, what option owed for a parent that has to account for non-controlling interest within its group account? What options owed for a parent that has to account for non-controlling interest within its group account? Hello? Who wants to try? What option owed for a parent that has to account for non-controlling interest within its group account?
Can I say something? Let me just try. I think the option holds for parents that has to account for non-controlling interest is basically 2 options.
Okay.
The first option is to view it from the proportionate share of identifiable net assets of the subsidiary. While the second option is to measure it based on fair value of the subsidiary net assets.
Okay, yeah. Is there somebody that wants to say something regarding that? I think I quite agree with your position that those are the 2 ways of measuring NCI, the proportionate share and also based on fair value. So we go to the question 9. Why will subsidiary assets and liabilities be consolidated 100% with that of the parent assets and liabilities without recourse, that is, without giving consideration to the percentage ownership or holdings in the subsidiary? Why will subsidiaries' assets and liabilities be consolidated 100% that of the parent assets and liabilities without recourse, that is, without giving consideration to the percentage ownership or holdings in the subsidiary. Please, the floor is open. Olawale. Madam Oladokun, are you there? Mr. Sunday.
Yes. If I understand the question very well.
Okay.
The question is saying that if I understand the question very well, I understand the question first and foremost. Like why are we consolidating the assets and the liability? And we now have only the asset liability without why not the percent controlling interest of the assets and liability? I think the reason why we are consolidating 100% is because what the parent company is exercising is a control. It's a control. The only company is the one making the decision about the operations of the subsidiary. So the control of the entire operations of the subsidiary is resident with the holding company. And I think that is the reason why we are consolidating the asset and liability 100%.
Okay, but the question says without recourse to the percentage ownership or holding.
And that's what I'm saying. If I understand the question very well, I think the question is saying that why are we recognizing asset and liability 100% and not the controlled percentage? Let's say the holding company has 70% in the subsidiary, for instance. Why not report asset and liability at 70% instead of the 100?
Yes.
That's one part of the question.
Yes.
I'm not saying that the responsibility of the parent company is control. The only company is exercising control over the entire asset and liability of the subsidiary for the benefit of all. So that is the reason why they are taking everything into the consolidated account and not just the percentage holding of the asset and liability. Okay. My thinking.
Yeah, because of the existence of control. Yeah, that is why 100% of the asset and liabilities of our subsidiary, we have to be consolidated into the group accounts. So the last question, what constitutes a partly owned subsidiary and of what implication is it in acquisition date accounting? What constitutes a partly owned subsidiary and of what implication is it in acquisition date accounting? So we must first be able to differentiate between wholly owned subsidiary and partly owned subsidiary.
If I must come in here too as well, I think what constitutes partly owned subsidiary is the controlling interest and non-controlling interest. There is controlling interest on the part of the parent company, and there's not controlling interest on the part of the other investors in the subsidiary other than the parent company. And the implication of this is that on the date of acquisition, the non-controlling interest will be reflected in the consolidated balance sheet.
On the date of acquisition, we are not going to...
In the consolidated account anyway, the non-controlling interest will be reflected.
Okay, it's all right. Who else wants to try? Olubumi, do you want to add something to it? All right, let me go to someone else. Asama.
Please let me pass, please.
What did you say?
Please let me pass. Let someone contribute.
Okay, it's all right.
Let me add to what Abolade said. For partly owned subsidiary, it implies that the parent is not is not having 100% stake in the subsidiary. However, the implication of that is that for when we are determining the cost of business, it means the proportionate of non-controlling interest will also be recognized in order to arrive at 100% value of the business before we net off the identifiable net assets of the subsidiaries. Thank you.
Okay, thank you very much. It just, the partly owned simply means that there's other people that are contributing to the equity of the subsidiary apart from the parent. So that means a certain percentage that goes to the NCI, and the implication at acquisition date is that the proportion that NCI is also bringing into the business combination must be reflected before we net off the net assets of the subsidiary from it. So that is it. All the questions have been trashed out.
Okay, thank you, my brother and friend, Shegun. Yeah. Okay, now I've presented something before us. We can see the guidance to the end of each chapter exercise on chapter 14. Now, I'll put up the question at my side, and I want Madam Grace to read the answer once I put up the question. The first question says, what does consolidation entails in the context of group accounts? Now, we'll look at this answer with the aim of trying to align it to all what we have discussed so far, whether we are in sync and what we need to do next. Madam, over to you. I've asked.
Consolidation and
continue, ma'am.
Consolidation entails the mechanism or process of combining the accounts of the parents and the subsidiary in order to obtain the single account that depicts the financial position, financial performance, financial position, financial performance, and cash flows of the group as a whole.
Does that make sense to us?
Yes.
Okay. Second question says, how can a non-controlling interest be recognized in a wholly owned acquisition of a subsidiary? Underline the word, how can a non-controlling interest be recognized in a wholly owned acquisition of a subsidiary? Madam, what is it here?
In a wholly owned subsidiary, all of the interest in the subsidiary are attributable solely to the parent. Invariably, there is no non-controlling interest in a wholly owned subsidiary.
Can you see the logic in the question? That question simply tests your understanding. How can you have non-controlling interest when you claim that a subsidiary is wholly owned? What is a wholly owned subsidiary? It's a subsidiary of which all of its equity interests are held by the parents. Now, the third question says, how can a non-controlling interest be described? Over to you, ma'am.
A non-controlling interest represents the equity interest in a subsidiary other than those of the parents, or controlling interest in the net assets of a subsidiary.
That's it. Every other interest in the net assets of subsidiary that cannot be attributed to that of the parent or controlling interest are considered as non-controlling interest. Next one says, why the cancellation of the fair value amount of both the equity investment in the subsidiary and the subsidiary's acquisition date net assets? Over to you, ma'am.
To cancel out the fair value of...
Madam,
okay.
Your voice is breaking. Can you start again?
Yeah. Yeah. The fair value of purchase consideration.
No, I think your network is bad. It's breaking, seriously. Okay, what happened is that I'll put it over to Mr. Sunday Ajibola, I hope you have a better network. Can you answer the fourth question?
The requirement of consolidation to cancel out the fair value of the purchase consideration and the net asset acquired in a subsidiary as at acquisition date is to reflect the concept of the single economic unit or single economic entity, thereby giving rise to the recognition of goodwill or gain or bargain purchase.
Now, at this point, they've told us the reason why we cancel out in order to obtain whether there's any goodwill or gain or bargain purchase. But unfortunately, we don't know what goodwill is at this point. Neither do we know what gain or bargain purchase is. But probably this will lead us to the next level we are going into. Okay, the fifth question says that distinguish between pre-acquisition reserves and post-acquisition reserves and their accounting implications at the acquisition date. Recall, there are salient things here. It says distinguish between pre-acquisition reserves and post-acquisition reserves and their accounting implications at the acquisition date. Over to you, sir.
Okay. Pre-acquisition reserves represents reserves of the subsidiary as at acquisition, which forms part of the subsidiary's net asset acquired in a business combination. Post-acquisition reserves are profits or losses arising from the involvement of the parent in both the financial and operating policies of the subsidiary since acquisition. Pre-acquisition reserve as a component of the net asset acquired in the subsidiary influence the amount of goodwill or gain or bargain purchase recognized on acquisition of a subsidiary, while the post-acquisition reserve are consolidated in the group account, but attributable to both the parent and non-controlling interest in the proportion the subsidiary's profit or loss is shared.
Okay. Now let's look at the 6th to the 10th one. Question 6 says, IFRS 3 does require the net off or cancellation of both the equity investment in the subsidiary and the subsidiary acquisition net assets. What is the essence?
Okay. The essence of the cancellation of the fair value consideration on the acquisition of a subsidiary as against the fair value of the subsidiary's identifiable net asset is to reflect the concept of the single economic unit or single economic entity, thereby giving rise to the recognition of goodwill or gain on bargain purchase.
Number says, can a conclusion be reached that the cancellation of both equity investment in the subsidiary and the subsidiary's acquisition net asset perfectly offset or net off?
Okay. This argument is not valid.
Yeah, continue. 7.
As it is a rare occurrence. The cancellation of the fair...
Start again, please.
Okay. This argument is not valid as it is a rare occurrence. The cancellation of the fair value consideration on the acquisition of a subsidiary as against the fair value of subsidiaries' identifiable net asset at acquisition may also result in either of goodwill or gain on bargain purchase.
Yeah, which means all what you have done before will have law us towards assuming that it will perfectly offset. But the next level we are moving to, we start to see deviation from that. Okay. Question 8 says, what options hold for a parent that has to account for non-controlling interest within group accounts?
Okay. A parent in a business combination may elect to either account for non-controlling interest at the proportionate share of their identifiable assets and liability, including recognizable contingent liabilities, or fair value of the equity instrument of the subsidiary at acquisition date.
Now, it's shocking to us at this level that what we are used to is only one methodology for accounting accounting for the stake of non-controlling interest, which is at the proportionate share. Therefore, now we have realized that there is another method or option. When are we going to get there? Probably in the next level of our discussion. Questionnaire says, why will subsidiaries' assets and liabilities be consolidated 100% without that of the parent asset and liabilities, without recourse to the percentage ownership in the subsidiary? What question is saying is that, remember, we have done 3 illustrations. The first illustration, we own the subsidiary 100%, and we consolidated asset and liabilities of subsidiary 100%. I think there was no obvious issue with that.
Yes.
But the second and the third, one was 80, one was 70, but we still end up consolidating 100% of the assets and liabilities. The question is why?
Okay.
Why can't you consolidate 70% since I own 70%? Why can't I consolidate 80% in the second one? What is the justification for going ahead with 100% without cognizance to the percentage we owed in the subsidiary?
Okay. Consolidation of the entire amount.
Over to you, sir.
Consolidation of the entire amount of subsidiaries' assets and liability is as a result of the fact that control is 100% involvement in the financial and operating policies of the subsidiary, which is represented by the element of financial position, that is, asset and liability of the subsidiary.
That's it. Control is total. As I'll give an example, in US today, Biden barely win about 54% or 55% of the vote. Trump lost with about 45% of the vote. But today, Biden has control of the whole US, whether you like him or not, whether you vote for him or not. But he controls the entire country because the word president means that you are the president over everyone, not necessarily over those that elected you. The same thing talks about control. Though I don't own 100%, but the whole affairs has been bestowed upon me in my fiduciary capacity to control it on behalf of others, apart from my own stake. And that is what it means. Lastly, question 10 says, what constitutes a partly-owned subsidiary, and of what implication is it in acquisition date accounting? The question is, what is acquisition date accounting? And what constitutes a partly-owned subsidiary? And therefore, what implication arose from that?
Yeah. A partly owned subsidiary is a subsidiary co-owned by the parents and other equity interest holders, known as non-controlling interest. Upon acquisition, the parent has a responsibility to measure the amount of non-controlling interest in the subsidiary and recognize him within the entity, but as a separate class.
Well, let's bring us to the end of this first session. What we'll do now is I will go on a short break, 10 minutes, and we'll return to move to the next level of our discussion, where we have laid the foundation of the first, second, and third principles, and from there, we'll build upon it at the next level. Thank you very much. Okay, welcome back. We'll be looking at chapter 5 of our material. And chapter 5 borders on accounting for goodwill and gain on bargain purchase. You remember that our discussion in the last section today more or less had a pointer towards goodwill, gain on bargain purchase. What do they mean by that? Okay, that's what we want to understand. But something will lead to something, and something begets something. And to do that, what I'll do at this level is to use an illustration to unveil what we likely discuss with respect to goodwill or gain arising from a bargain purchase transaction. Now, let's look at something briefly. And I'll use that to unveil our discussion. Let me cut off this and bring it to our notebook, the virtual notes. Okay, I'm sharing the screen now for the virtual notes. Now, this is what has been given to us at this level, and we're required to have a consideration of that. Now, similar thing we've done before now is what we're going to repeat. And I want somebody to read this question out. Who read the question?
Okay, I read. Pali acquired 100% of the equity share capital of SUSI at the reporting date 31st December 2015. The statement of financial position of the dual companies on this date is as shown below. Statement of financial position as at 31st December 2015. Property, plant and equipment for Pali 300, SUSI 130. Investment in SUSI for Pali 220. Current assets Pali 120, SUSI 70. Total assets 640 for Pali and SUSI 200. Share capital and reserves. Equity share capital at 1 naira per share for Pali 400 and for SUSI 120. Reserves, that is retained earnings, for Pali 160 and for SUSI 60. Current liabilities for Pali 80 and for SUSI 20. Total equity and liabilities for Pali 640 and for SUSI 200, and all figures are in million.
Thank you very much. Now, what do we do? The first thing we do is to put up our structure. Pali has taken what? SUSI. And in this case, all of the stake is 100%, which means there's no non-controlling interest. Our date of acquisition was 31st December 2015. And likewise, we are reporting on the same date, which means in this regard, there is no post-acquisition reserves. All reserves are pre-acquisition. Recall our first principle. We borders on what? Cancellation. All figure in millions. Now, what is our cost of business combination? We pair that with the value of our net assets of SUSI as at the date of acquisition. What do we need? We needed the investment of Pali in SUSI. And we needed the investment of NCI also in what? SUSI. Now, from the information we have here, investment of Pali in SUSI stood at 220. By so doing, we bring 220 here. Why that of NCI will be determined with respect to the stake, which in this case is what? Is 0% in the net assets, which means is 0 in anything is what? Is 0, even though we'll complete the process. Net assets is made up of share capital of SUSI and pre-acquisition reserves. The share capital in SUSI is 120, and the entire reserve is 60. And because this is still at the date of acquisition, therefore the entire 60 is pre-acquisition. Therefore, I come here to have 120 and 60, which make up 180. Invariably, 0% of 180 is 0. And now we have what I would term an excess purchase price. Excess what? Purchase what?
Nice.
Price. In a business combination. And how much is that? 40. Which means by the time we cancel 180 from this, we are left out with 40. And this 40 is excess purchase price. Literally, what is this excess purchase price? Excess purchase price is simply the amount you pay in excess of the net worth of the subsidiary based on its carrying amount or its book value. Now, this excess purchase price which you can also call excess purchase consideration, is attributable to two things. And we're going to explain it. It's attributable to two things. One and two, which means this 40 is attributable to two things, and we're going to explain. But before I explain, I've talked about the literal meaning of excess purchase price. What you pay above the value of the subsidiary you have taken over based on its position in the balance sheet of the company. Now, let me share something with us. I try to share I want to Google it. Let me share that with us because this is a practical session. Therefore, we also need to learn across boundaries. Now, what is excess purchase price here? Can somebody read this narrative here?
Excess purchase price means, with respect to any acquisition, the amount allocated to the tangible and intangible assets of the target or seller The excess of the value of the tangible asset of such target or seller as recorded immediately prior to such acquisition.
Okay. Now, let me move further. Yeah, let me move further here. Okay, before that, let me check this. Okay, can you read this? How do you calculate excess purchase price?
Yes. Calculate the
Your network is breaking. Your
by
network is
taking the difference.
sorry. Olubukola, can you read that? Olubumi, sorry. The network of Oladoku is breaking.
Okay, sir. Next, calculate the excess purchase price by taking the difference between the actual purchase price paid to acquire the target company and the net book value of the company's assets minus liabilities.
Thank you. Thank you. Thank you. That's what we're trying to say. Okay, let's look at this again. Okay, that's purchase price. No, the excess purchase price is what I've looked at. Okay, thank you. Now let me go down here to see one or two things. Because people misconstrue what excess purchase price is. Okay, I want somebody to read this. What is purchase price allocation? Olubukola, I can continue. Bumi, go ahead, please. Okay, I think our network is off. Okay, Shegun, can you go ahead? What is purchase price allocation?
Okay, in acquisition accounting, purchase price allocation is a practice in which an acquirer allocates the purchase price into the assets and liabilities of the target company acquired in the transaction. Purchase price allocation is an important step in accounting reporting after the completion of a merger and acquisition. The currently accepted accounting standards, such as International Financial Reporting Standards, IFRS, require employing the purchase price allocation method for any type of business combination deal, including both mergers and acquisitions. Note that past accounting standards required purchase price allocation only in acquisition deals. Components of purchase price allocation. Purchase price allocation primarily consists of the following components: net identifiable assets. Net identifiable assets refers to the total value of assets of an acquired company, less the total amount of its liabilities. Note that the identifiable assets are those with a certain value at a given point in time and whose benefits can be recognized and reasonably quantified. Essentially, the net identifiable assets represent the book value of assets on the balance sheet of the acquired company. It is important to understand that identifiable assets may include both tangible and intangible assets. Write-up. A write-up is an adjusting increase to the book value of an asset that is made if the asset's carrying value is less than its fair market value. The write-up amount is determined when an independent business valuation specialist completes the assessment of the fair value of the assets of a target company. Goodwill. Essentially, goodwill is the amount paid in excess of the target company's net value of its assets minus its liabilities. Goodwill is calculated as a difference between the purchase price and the total value of assets and liabilities of an acquired company. From an acquirer's perspective, goodwill is critical in its accounting reporting because both US GAAP and IFRS requires a company to reevaluate all recorded goodwill at least once a year and record impairment adjustments if necessary. Goodwill is not depreciated, but is sometimes amortized over time. Note that acquisition-related costs, including both not limited, note that acquisition-related costs, including but not limited to various legal, advisory, or consulting fees, are not considered in purchase price allocation. According to accounting standards, an acquirer must expense the cost whenever they have been charged, while the corresponding services have been provided.
Thank you. Now, you know what we try to prove here? An average person will have concluded that this 40 is goodwill. And I do tell people that it's not, and I will explain. That's why I said, excess purchase price, what is it attributed to? Remember, we're told that purchase price is allocated to three things. The first is the net asset, which is this. The second is what we call the first for excess purchase price. And the third is what we call the second for excess purchase price. Now, excess purchase price take care of the other two out of the three. And what are they? One, current prices, or what we call fair value adjustments, is the first thing that we attribute excess purchase price to. The second thing is what I'll call residual. And I'll explain what residual is tantamount to. Now, let me start with the first one. What is current price adjustment? That is what here is being referred to as write-up. What is write-up? Remember that the net assets in the books of the subsidiary, which represent the carrying amount, is known as the net book value of the company. And bulk of the value of the company or carrying amount are carried at historical cost, which are not usually a reflection of the current value. What is the current value? The current value could be the fair value, could be the present value, or could be the current cost attributable to assets and liabilities, which are based on current condition, based on the measurement period or date. But historical values are a reflection of the transaction value in the past, which may not reflect what the value is today. But that has been the convention to which we prepare our financial statements. To simplify it, let us pick one item. Out of the component of assets and liabilities acquired, one of them is land. And this land was bought 10 years ago for 10 million naira. Today, the land is still shown in the books at 10 million naira. We constitute a component of that net assets. The question then is, even if the company is to strip off all its assets one by one and sell, will it sell the land for 10 million? The simple answer is no. What will it sell the land for? It will sell it for at the current value, which probably might have gotten to 15 million. The question then is, the first thing that is taken into consideration in the pricing of a business upon negotiation of its acquisition is to reflect the current prices of assets and liabilities that are carried by the company in its books. And that speaks to the current price adjustment, or what we call fair value adjustment, or what in this case it is called a write-up adjustment. That means if that is the case, if we come back to our slide here, and we see that this current price adjustment is 5, hypothetically, it then means that the balance, which I call residual, is what? Is 35. This balance is not measured. It is the result of the difference after we have allocated, out of this 220, we have allocated 180 to the net assets. We have allocated 5 to write up. What is unallocated is the balance of 35, which we call residual. But what does this residual stand for? Is what we need to know. The residual takes care of other intangible substances attributable to the acquisition, which include the following. 1, what do you pay for in excess other than the value of the assets, other than the adjustment for current prices, are things like the market share, are things like the brand, are things like the quality, are things like customers' loyalty, are things like customers' list, are things like reputation, are things like what's it called, reputation, synergy, are things like proximity to the market. 8, things like what are the things that give commercial advantage to a business over others? Things like history or longevity, etc. All of these are things that, when you gather it together, are things that exist in the acquired or target business that place it above others, so that you are willing to take that company rather than take over another company. And all of this, including potentials, are what we gather together to subsume as goodwill. To subsume as what? Goodwill. Therefore, how do we describe the goodwill? In this case, we say goodwill represents the commercial advantage a business or an acquired business has over its competitors. Have over what? Its competitors. That is it. And what are the things that give commercial advantage over your competitors? The market share, the brand, the quality of your product, the customer loyalty, the number of customers you have in terms of list and record, which we call data in today's world, which is the next oil. Reputation, synergy, proximity, longevity in terms of your history and potentials you have. All of this are what are embedded in you that give you an advantage over others, which we classify as what? Goodwill. Which then means invariably I'll come here to say what I mean or meant by residual or the balance is what? Goodwill. Now this is scenario 1. In scenario 2, if peradventure I allocate is 0 to my current prices because all of the assets and liabilities are already carried at their fair value, it then means that the entire 40 which is a balance will be attributed to goodwill. Also, if we assume under scenario 3 to say the current prices is 40, and we remember the entire excess price is also 40. It means in this scenario, what we are saying is that there's no amount of goodwill in the business. And the last scenario is an exception, which we are going to discuss later on. What if what we have here is 50, but our excess purchase price is 40. Therefore, what we have as a balance is negative of 10. What could bring about this? This is a dicey situation. Therefore, because it's dicey, I will highlight it and say we'll come back to this. This is an abnormal situation. And probably this speaks to something. But at this level, I don't know what it speaks to. But we'll come back to that. But again, from what we have here, we'll be able to see that the 40, which is the excess purchase price, can be allocated in any of this order to fair value adjustment in order to reflect current prices and the remaining to goodwill. Okay? But here we can find out that all our goodwill are positive. But unfortunately, at the last scenario, our goodwill is negative. Is that possible? If possible, what could result to that? How do we do that? How do we treat it? What will be the subsequent implication of such a treatment? These are the things we'll get to know as we move on. Any question at this point before we move further in solving the problem? The floor is open.
Okay, please, I would like to ask a question. Like, we've always made to know that goodwill is the excess of purchase consideration over the identifiable net assets of a company. And in fact, the dimension you are taking it's a little bit different from my prior understanding. So I want to know, is this still IFRS requirements? And in an exam situation, can we define goodwill as you have put it, that goodwill represents the commercial advantage of an acquired business as over its competitors?
Okay, now what we have done is to describe goodwill in this context. Okay, we have not decided to determine how goodwill is obtained. What we have done is to describe the goodwill. Are you getting me now?
Yes,
Now, let me try and check something for you. Hold on. If I see it, I'll share the screen with you. Please hold on. There's this stuff that ACCA does with their students, so that it gives them some level of clarification when they are attempting to answer questions. Okay, they try to tell them what each nomenclature stands for, and that gives them a better understanding of what is required. Just give me a few minutes. Okay, I didn't see it here, but let me go on Google to check what I'm trying to, and that will more or less assist you as you move forward. Okay, I've seen it now. Okay, can you see it?
Yes, sir.
Answer questions. This is ACCA part. How do you answer a question? When answering an exam question, and I'm doing this because you tutored it towards exam. When answering an exam question, it's important to consider the question's requirement carefully to make sure you understand exactly what is being asked. We highlight some common questions, verbs used in exam. When they say analyze, means break into separate parts and discuss, examine, interpret each part. Give reason for the current situation or what has happened. When you say apply, now come here. When you say define, means give meaning, usually meaning specific to the course or subject, like explain the exact meaning, because usually definitions are short. When they say describe, give a detailed account or key feature, like characteristics, qualities, parts. Make a picture with words. Identification is not sufficient. Are you getting what I'm saying now?
Yes, sir.
Now, what did I say here? I said, in this case, okay, how do we describe goodwill? And I said, in this case, we say goodwill represents Are you getting what I'm saying now? I'm not quantifying it. You will now see where we want to quantify goodwill. You will see what you mean or what you expect. I remember, yeah, they said something about definition. They said definition are what? Are short. Can you see that?
Yes, sir.
Because definition is for students to just have a short understanding of it. But first thing you need to know is that we are not students in this case, or we are more than students, we are professionals, which means we need to understand in detail what gives rise to something, rather than just say, goodwill is this. Do you even know what that goodwill is, other than you just saying this is what they said it is? How many times have people come across this to understand that when we talk about goodwill, it's nothing other than taking care of all what is left that is unidentifiable separately, but can be traced to any of these or more. Am I making sense?
Yes, sir. Perfect.
Therefore, let us now try and solve the problem and come to a conclusion of what goodwill is. Which means in this case now, sorry, I have to clean this up. Our excess purchase price is attributed to now current price adjustments or fair value what? Adjustments. In this case is nil. Who can tell me why it is 0? In this case, why is it 0? Who can tell me why is it 0? Nuruddin, why is it 0?
Well, I don't know the exact why, but if I guess, if the net assets of the subsidiary is measured at fair value already, I think it could be 0.
I said in this case, you have all of the information in this case. I don't want us to assume. Remember, the information is exhaustive in the question we are solving. Let me take you back to the question so that with this information available now, why have we concluded that attribution of excess purchase price to current price adjustment is 0? Why?
If I can just add to it, because there's nothing in the question that indicates that there's a difference between the current purchase price and the amounts given in the question. So there's no notes or whatever that will guide us to know whether there's a difference between the market price and the book value that we've seen.
Are you sure?
Yes.
Are you sure? No, I think I want somebody else to say something before I put up my own comment. And we'll move on. Mr. Sunday.
I'm still looking at it.
Olubumi.
200.
I'll still agree with what Mr. Shegun said, that it wasn't stated in the question that there was an adjustment on the price. So,
Which price? Adjustment on which price?
so it wasn't stated that the value of the business.
Okay. Now let me assist you guys. I was agreeing with Chegun until he diverted. And what is it? The information here has not provided us avenue to contemplate that the current values of assets and liabilities, not of the investment now, is different from what is reported in the books, which means there's no information telling us that the carrying amount of the assets and liabilities of Suzy as at the acquisition date vary from the current value. And if that is not given to us, it is presumed that they are the same. Which then means that in that case, there's nothing to write up or write down, as the case may be. Because in some rare situation, it might be write down. But in most of the cases, it's write up. Now, there's no such information. Therefore, we conclude that I can't leave this place and go to the market and say, okay, let me go and confirm each asset and liabilities of Suzy, whether it varies. Which means that in that case, it is zero. And as we move on, you now see evidence of where will be provided such information. If that is the case, it then means that the second thing is attributed to is goodwill, which takes care of all those things we discussed earlier. And that's how much? The balance of what? Of 40. That is that. Which means coincidentally, people will consider that, but this 40 is that same 40 you called goodwill. It is the same because there is nothing attributable to current price adjustment.
Mm-hmm.
The day you start to attribute to current price adjustment, that is the day you discover that they are not the same. And we are going to get there. And that is that. Therefore, what is goodwill by definition? So that I meet the expectation of my brother Shegun. And what is his expectation? What is goodwill? IFRS 3 defines goodwill as what? As the assets of I have to charge my laptop. The assets of the fair value of purchase consideration. And what is purchase consideration? That is investment in ordinary shares of the subsidiary by the parent, and the value, the amount of the non-controlling what? Interest. In the subsidiary. That means what I put in bracket is just an explanation. it need not to be part of the definition, which means the essence of the fair value of purchase consideration over the fair value of the subsidiaries identifiable assets and liabilities, which we know as net worth assets, including contingent liability, of the subsidiary that can be reliably measured at fair worth value at the acquisition date. Mr. Shegun.
Yes, sir.
Does this now meet your expectation?
Yes, sir.
Okay. Now, the underlying keywords are as follows. I'll put them in red. The word excess describes the excess purchase price. Now, fair value of purchase consideration means this amount here, this cost of combination must have been measured at fair worth value. And this cost of combination comprises of investment of parent and that of the amount of NCI. Second, shifted, okay? Second, we compare that with the fair value of the subsidiary net worth assets. But look at this word, fair value. Let's ask ourselves, what do we have from the balance sheet of a company? Is it fair value or carrying amount? It is a carrying amount, which is usually what we call the net book worth value or the book value. Now, where you find out that when this operation took place, we have no information that this is fair value because all what we pick here are from the what? From the books of the subsidiary. Therefore, we call this book value. But for it to be goodwill, it must be fair value we compare it with. But what we are comparing it with is what? Book value, which means we have not adjusted for current prices. Therefore, what we get will not have been goodwill unless we compare it with fair value. What we get is excess purchase price. It is when we compare it with fair value that we now adjust for this amount that we have here. Unfortunately, our adjustment shows is zero, that our kind amount of book value approximates the fair value. But if not, we'll have done either of this or this or this, so that it will have influenced our determination of what? Goodwill. Therefore, as we move on, we will see that when we get to fair value adjustments. But this is what we call goodwill. But if this is changed, this fair value, assuming I change this fair value, I'll come back to erase it. Assuming I change this fair value to book value or carrying amount, what will have been this definition? Will it have been goodwill? Will it have been goodwill if I've changed this to book value? What will it be? Will you still call it goodwill? What will you call it?
Excess purchase price.
That is simple. Because you are yet to adjust for the current what? Prices. Therefore, I return it back. These are salient things you don't learn directly in class. Because if you are to go towards the detail where you are about qualifying, it will be too much for you to swallow. But as professional now that you have had some level of experience, you can be able to reason it out and go deeper in it. Okay. Therefore, I'll come back and say fair what? Value. Does it make sense now?
Yes, sir.
Now we can continue. What then is what do we need to do now? Because we are at the date of acquisition, therefore this for the first time did not totally cancel out. And upon our analysis, we've resolved to say it is goodwill. Therefore, what do we do? Let us now show our financial position. Pali Group. What's wrong with my pen? It seems my pen is tired. Okay, it's up now. Pali Group. Consolidated statement of financial position as at 31 December 2015. All figures in millions. Assets, which can be grouped into non-current assets and current assets. Let's pick it one by one. What is our property, plant, and equipment? 300 and 130. $300 and 130. That gives me 430. Investment has cancelled out, and the result gave us goodwill, whereas I have current asset of 120 and 70. Remember, I have current assets 120 and 70. That's 190. But before 190, investment that cancelled out will finally resolve that it gave us goodwill of 40. Therefore, goodwill will be reported here as 40. And what is the nature of goodwill? Is an intangible asset. And you can refer to that under IS 36, which we'll get to 40. That should give us 470. All in all, what's our total assets? 660. This is financed by equity and liabilities. And our equity comprises of share capital and reserves. Share capital will be for Pali alone. Why? If you come back here, share capital of this has been cancelled out. Likewise, the reserve, which means we come here and say we have share capital of Pali, which is 120. Is it 120? No, sorry, 400. And we have reserve of Pali, 160. Therefore, I come here, I'll say this is this is 400 and reserves or retained earnings, as the case may be, is also Pali because we are still at the date of acquisition, 160. Now, since we have no non-controlling interest, or I can still say this is 560, which is the equity attributable to Pali. What is the equity attributable to non-controlling interest? Since we have no non-controlling interest to be what? Zero. It means that 560 is equally our total what? Equity. Next is our current liabilities, which from our information here, it is 80 and 20. That's what 100. What do you have? 660. And that gives us what? Total equity. And what? Liabilities. Does it make sense to anyone? Does it make sense to us?
Yes, sir.
Any question at this point? Which means now we have introduced ourselves to what Goodwill is. Goodwill arose from the commercial advantage that the target company has over its competitor, which upon acquisition, based on it has been purchased and paid for by the acquirer, it becomes a purchased goodwill, or what we call the acquired goodwill, which is the only form of goodwill allowed by provision of IS 38 to be recognized as an asset in the books of the acquirer. And in such case, we recognize it as an intangible asset. Why? Because one, it is an asset that will bring forth economic benefit for more than one accounting period. Two, it's an asset that has no physical substance, or because bulk of what could have resulted in a goodwill. From the information we are going to see now, my screen, what's happening, is attributable to intangible substances, substances of no physical nature. I think my stuff went off. Okay, sorry for that. Let me share back my slide. Okay. Okay, I'm back with my slide. Okay. I'm back with my slide. Okay, as I've said earlier, therefore, this is what the good is attributable to. And we said that gives the commercial advantage. What are the things can it be attributed to? Market share, the brand, the quality, the synergy, the customer loyalty, customers list, reputation, synergy, proximity to market, or raw materials, or any other thing you talk about, historical nature of the business in terms of its longevity, potential the companies have. All of these are what give that commercial advantage, which by definition, the goodwill can be determined as the excess that has been paid by way of purchase consideration over the fair value of the net identifiable net asset that has been acquired by the acquirer as at the measurement date, which is the date of acquisition. Okay. Any other thing before we move ahead from here? Okay, if there's none, what happened? My other solution has cut off. Let me search for it. It has disappeared. Okay, let me just put it back. Equity and liabilities. Share capital and reserves. Share capital. Value. Our retained earnings. Value. That's equity attributable to value. Equity attributable to non-controlling interest. NCI is 0. That's our total equity. Current liabilities. We had 80 and 20. This 100. Okay. Now, the next level of our discussion is what alternative accounting option or options exist for non-controlling interest, which is NCI at acquisition date. Who can help answer this question? Who can help to answer this question?
Yes, sir.
Okay.
From parts of the question you shared, I think we came across this question as well. Or we've answered it that we have two possible methods to measure non-controlling interest. The first one is adopting proportionate shares of share of identifiable net assets of the subsidiary. Why the second one now is adopting fair value measurements.
Okay, thank you very much, sir. The two options are as follows. Option one, which is the default, is that we measure NCI as proportionate share of the identifiable net worth assets of the subsidiary as at date of what? Acquisition. The second alternative is to measure it at acquisition date, fair value of the equity instrument. Held by the NCI in the subsidiary. What it means is that you use the price per share, which is also known as the market price of the shares of the subsidiary, to multiply the number of shares of that subsidiary that is in the hands of the non-controlling interest. And that is what we mean by acquisition date fair value of the equity interest held by NCI in the subsidiary. Now, what do we do? This methodology will give rise to something. What will it give rise to? Remember that we have determined goodwill. And you find out that in this regard, goodwill will not take either of these two forms. Goodwill can later now be recognized as partial goodwill or can later be recognized as full goodwill. What is the difference? The difference is that partial goodwill only recognize goodwill contribution. By the parents alone. Whereas full goodwill recognizes goodwill contribution by who? By the parent and by who? By the NCI. Now, later on, we are going to demystify today how this choice of accounting for NCI give rise to the recognition of a partial goodwill. And today also, we are going to recognize how this second option, which is measuring NCI at fair value as at acquisition date, give rise to the recognition of full goodwill. Now, what is partial goodwill? Partial goodwill is the goodwill you recognize upon acquisition of a subsidiary to the extent of the parent contribution only. While full goodwill is the goodwill you recognize in a subsidiary where you recognize both the parent contribution alongside with the NCI's contribution. The next question we ask is, which one are we required to adopt? Because the standard recognizes it as an option, the two are open as a choice of method to the group. The next question I will now ask is, if these two are open as a measure to the group, which method or option is more preferable and why? Which method or option is more preferable and why? I want anybody to answer that. From your experience, which option is more preferable and why? Open to you. Madam Grace, let us start with you, ma'am. Madam Grace, we are with you.
What's the question, sir?
Okay, the question is, which option is more preferable between measuring non-controlling interest as proportionate share of the identifiable net asset as at acquisition date, or measuring it at acquisition date fair value of the equity instrument held by non-controlling interest in the subsidiary? We can't hear you. You're muted.
Option, sir. Option 2. At acquisition date at fair value of the equity instrument.
Can you tell us why?
By the non-controlling interest in the subsidiary.
I don't think that network is bad. Who else can come in? Asama.
Can I pass, sir?
Okay. Yeah, this is the second or third time you are passing. We'll block your passing. And now, I've not had you since today. You have been passive today. Why?
Where I've been passive. I'm a little bit, I'm very strong. Let me.
Sorry.
I just had to follow through. But to respond to your question, I think the full, there is the NCI using the fair value method. I think that is better.
Why is it better?
Because as you know, it is properly, if you measure by fair value, it gives you the value, the market value as of today. So basically that's better than using the proportionate method. That's why I look at it. And I think more so, IFRS is moving towards fair value for measurement than using historical costs. So I think that is my own position.
Okay, let us quickly go to the end of chapter question. Let us see whether such question exists. And let's try to put answer to it. Okay. Now, the question I can see here, probably close to it, says, what influence does the choice of accounting policy? Okay, I think I didn't share the slide with you, sorry. Can you see it now? Can you guys see it?
Yes.
Now, and now, can you read question 3?
Okay. What influence does the choice of accounting policy in measuring the NCI at acquisition have on the amount of goodwill to be recognized in a business combination?
That is similar to the question that we have discussed now. Okay. Now, let me take you here, which is chapter 14. That's chapter 14. We now want to look at guidance to end of chapter 5. Can you read what is stated here?
Okay. There are 3. Okay. The accounting policy choice of measuring the amount on NCI at acquisition will influence the amount of goodwill recognized in a business combination. When NCI is measured at the acquisition date fair value of the equity instrument held, the amount of goodwill recognized will be in full, i.e. parent and non-controlling interest portions if it had been recognized.
Now, that speaks to it all. Now, let's move on from there. Moving on from there means I'll go back to my chapter 5, okay, and try to pick up a question. Now, I'll pick this question. I'll copy it. I've copied it and I'll paste it in my notes, which I'm sharing with you now. Okay. Mr. Nuruddin Bashir, can you read this question for us and let us see how we go ahead to consolidating this on 31st of December 2015?
Okay. Pali acquired 80% of the equity share capital of Suzy as at the reporting date, 31st December 2015. The statement of financial position of the two companies of this date stood as follows. Statement of financial position as at 31st December 2015. Pali Suzy. All figures in million. PPE, Pali 300, Suzy 130 million. Investments in Suzy 160 million. Current assets, Pali 120 million, Suzy 70 million. Share capital and reserves. Equity share capital at 1 naira per share, Pali 400 million, Suzy 120 million. Reserves, retained earnings, Pali 100 million, Suzy 60 million. The total for Pali 500 million, for Suzy 180 million. Current liabilities, Pali 80 million, Suzy 20 million. Total equity and liabilities, Pali 580 million, Suzy 200 million. Assuming the prevailing market price of Suzy's share prior to the date of acquisition is 2 naira per share.
Okay, who can explain what we need to do now for us to consolidate as at the reporting date at 4 December 2015?
I think the first thing we need to do is to find the market value of which is already given of the shares, then find it and convert the NCI. That is the NCI. We have to look at their value, the market value of the NCI actually, not the proportionate share. That's what I look at. That's where I see it.
Who else? Who else?
Okay, I want to try to arrive at the value of NCI contribution to this acquisition. We have to multiply the 20%, which is a percentage of NCI, with the share capital of Suzy, and then multiply that by 2 naira, which is the share value of Suzy. Then we add that to the contribution of the parents, and we net off the identifiable net asset of Suzy from it to arrive at whether our GD or gain of bargain purchase.
At this level, what I'll do is that I'll give you 10 minutes individually for us to solve it at our own point, and we'll converge by 2:20. This is 2:07. Individuals must do this and convert at 2:07. Thank you very much. Okay, welcome back to the continuation of the class. Babajide, you are just joining us now. Can you put up your camera and let us move ahead? Okay. Akin Falari, can you read the question at hand?
Hello, sir.
Can you read the question at hand?
Okay. Pali acquired 80% of the equity share capital of Suzy at the reporting date, 31st December 2015. The statement of financial position of the two companies on this date stood as follows. As at December 2015, all figures in millions. Property, plant, and equipment for Pali is 300, while for Suzy is 130. Investment in Suzy by Pali is 160. Current asset for Pali, 120, while Suzy is 70. Total assets for Pali, 580, and total asset for Suzy is 200. Share capital and reserves. Equity share capital at 1 naira each. For Pali is 400, and for Suzy at 1 naira is 120. Reserved and retained earnings, rather. For Pali is 100, and Suzy is 60. Current liabilities for Pali is 80, and current liability for Suzy is 20. So total equity and liability is 580, and for Suzy equals also 200. Assuming the prevailing market price of Suzy share capital as at the date of acquisition is 2 naira per share. Thank you.
Okay, thank you. this is how the structure looks like. Okay. Now, let's split the reserves. The reserves of Susie as at the reporting date is how much? Is 60 million. See whether we can split it into reserve as at the date of acquisition, which is our pre-acquisition reserve, or to post-acquisition profit or loss. Now, can anybody tell me the split in this case and why? Can you split this into pre and post-acquisition reserve?
I think we cannot split it because the date of acquisition is the same as the date of consolidation.
Yes. All of the reserve is pre-acquisition. Thank you. Okay, I just use that to assess our understanding. Now, moving forward, we are told that we have two options. Option A, where NCI is measured at proportionate share. Of the identifiable net assets of Susie as at the date of acquisition. Okay, that's option one. In that option, how do we determine our goodwill? Goodwill is determined as follows. Cost of business combination, Pali's investment in Susie, and NCI as measured as proportionate share. And we'll compare that with the net assets of subsidiary as at the date of acquisition, and which is made up of the share capital of Susie and the pre-acquisition reserves of Susie. What is the share capital? 120. What is the pre-acquisition? The entire 60, which we have in this case. And that is 120 and 60. That gives 180. Now, what is the investment of Pali? 160. Now, what is NCI? NCI, as we are used to that, based on proportionate share of the net assets as at acquisition, will be what? Will be the percentage NCI has multiplied by Susie's net assets. And the percentage here is 20% of what is the net assets? 180. That is how we got 36. If you go back to what we have been doing before, which means we come here to say this is 36. And when we add it to 160, give me 196. Since we have no attribution to current prices, the entire difference here is deemed to be the goodwill. But what do we call this goodwill? It's what I don't know for now, which we'll come back to. Now, let us compare this. What we have here, let us compare it with option 2. Let me try and clean this up. Rather than measure it at this, I'll measure it at acquisition date fair value of shares. And what does that mean? We'll come back to that. Now let me clean this up. NCI is measured at fair value of its equity stake in SUSI as at acquisition date. And in this case, we talk about the market price multiplied by number of shares held by NCI. Okay, we'll come down there. Now recall our stake, the investment of Pali in SUSI was 160. If you could remember, 160. Okay, NCI is what we don't know yet. Now, what is the NCI? The NCI is the market price. What is the market price? Remember in the question, they said, assuming the prevailing market price of SUSI shares prior to the date of acquisition at how much? 2 naira per share. We come here, we say 2 naira per share multiplied by the number of shares. But unfortunately, in the question, we are not given the number of shares held by NCI. Rather, we are given the share capital, which is this amount, 120. The share capital is 120 million naira. The first thing we need to do is to convert this share capital in naira to number of shares. That will tell us the number of shares SUSI has in the subsidiary, number of shares of SUSI as a subsidiary. Thereafter, we can find our percentage as NCI. Therefore, what do we do? I'll show you something here. Recall that the number of shares in a company is equivalent to the share capital divided by the nominal price. And what that means that the number of shares in SUSI will be the share capital of SUSI, which is 120 million naira, divided by what is the nominal price? The nominal price is 1 naira per share. Therefore, I divide it by 1 naira per share. Invariably, that gives me 120 million shares. Somebody would think and say 120 million shares, is it not the same thing as that 120 million naira? The answer is no. One is in naira, one is in units. But it is looking alike because the nominal price is 1 naira. Imagine the nominal price is 50 kobo or 2 naira or anything other than 1 naira, it will be obvious. And that's why you must take note of that. But of these 120 million shares, how many of it belongs to NCI in SUSI? Remember, NCI stake in SUSI is 20%. It means only 20% of this 120 million shares belongs to NCI, which means invariably 24 million shares belongs to NCI. If that is the case, it then means we come here to say 24 million shares. And each one in the market goes for 2 naira. It then means that the fair value of the shares of NCI as at acquisition date sum up to 48 million naira, which is what I'll bring here. Invariably, this is 208. Don't forget, our share capital remains the same at 120, and our pre-acquisition reserve remains the same at 60. Therefore, I come here to say 120 and 60, which is what? 180. What is the difference now? There's a goodwill of 28. Now, in one aspect, we had goodwill of 16. In the other bread, we have goodwill of 28. The question then is, let me go ahead to analyze goodwill. Analysis of full goodwill. That will give us a better understanding of what we want to discuss. Recall, we said something here, and we are going to prove it. We said whenever sorry, I'm coming. Okay, it's clear now. We said whenever we measure non-controlling interest as proportionate share of identifiable net asset of the subsidiary as a date of acquisition, any goodwill that arises from it is partial goodwill. See the arrow. Whereas if you measure at acquisition date fair value, the amount of non-controlling interest in the subsidiary, any goodwill we arrive at is full goodwill. And we say partial goodwill is goodwill that recognizes contribution of the parent alone, while full goodwill recognizes both the parent and the NCI. Now, let us relate it to this. I measure NCI at proportionate share here, which means whether I like it or not, the first conclusion I will say is that this is a partial goodwill. But it needs to be proved, which is where we are going to. Here, in this case, I measure NCI at acquisition date fair value. Therefore, I will conclude that this is full goodwill. But how do we arrive at full goodwill? We will prove it. And what is full goodwill and partial goodwill is known to us. Now, let us prove it now. I'll prove it from the angle of the full goodwill, this 28. Let us go back way of goodwill again. How is goodwill determined? We compare purchase consideration, or what you call purchase price. We compare it with the value of the net worth assets as measured at fair worth value. Even though at this level, we have not started to adjust for fair value. Now, if that is the case, from the information we have here, what is the purchase price? The purchase price is the cost of combination, which in this case is 208. What is the net asset? It's 180. This is how we got the 28, which is goodwill. No problem. But remember, the totality of what we have is attributed to the parent and attributed to the what? NCI. Now let us pick them one by one. This 208, the contribution flows from the fact that the parent invested 160 and the NCI investment was valued at 48. This is how we got this 160, 208. Then put it in red. $160 and 48. This net asset is the sum of the assets on individual basis and the liabilities, which is netted off to be 180. Now, this amount is to be shared between the parent and NCI in the proportion to which they have a stake of 80 and 20%. Therefore, I'll use ratio 80-20. Now, I'll pick my calculator. If we say today, let us share our assets one by one, and let us share our liability one by one, what am I going to have? Will be 80% of 180, which is 144. And 20% of 180, which is 36. Now, invariably, what is my goodwill contribution? Goodwill contributed by parents is the essence of 160, which is the purchase price of the parent, over his own share of the net asset in the subsidiary. That gives me 16. And what is the goodwill contribution by NCI? Is the purchase price allocated to the NCI over his own share in the NCI, which is what? 12. Which means this implied this. At the end of the day, what can we deduce? First, let us look at this. This amount of 16 is familiar to us. How is it familiar? It's familiar to us because this 16 somewhat represents 16 we have.
Oh, I was looking at that and I was like, it seems closer now.
Which is synonymous to what we have here. And which shows that this 16 is traceable to what we have here. Which is this 16 here, which means this 16 is what flows there because we only recognize goodwill that is attributed to the parent alone. Whereas if we have decided to recognize in full, we'll have recognized not only the parent, but we recognize the parent, which is 16, and we recognize the NCI, which is what? 12. By so doing, what we are doing is we're recognizing full, which is 16 plus 12 is this 28, which is what we can find here. It is full because the goodwill of parent 16 and of NCI 12 is what we have recognized. It is partial here because the goodwill recognized is only 16, which can be attributed to the parent. And that simply explains what we mean by full goodwill and partial goodwill, which arose from the fact that we have this accounting policy of fair value as at acquisition date or proportionate share of the net asset at acquisition date. Any question at that point before we show the position in the balance sheet? Any question? Okay, in the absence of the question, let us now show the balance sheet. Let me copy one of the old balance sheet here. Okay. It's the same date, but let me clean what I have here. Okay, now we have two options. Option A and option what? B. Now, what is option A? Option A is where we measure at proportionate share. And option B, let me correct this, option B is where we measure at fair value. Therefore, what is my PPE? Let me copy the question and put it on this side. I will easily see it. I have 300 and 130. That gives me 430 apiece. My goodwill, one gave me 16, which is here. The other one gave me 28, which is here. 16 and what? 28. I'm putting it side by side for ease of comparison. What is my current assets? 120, 70. Remember, this has cancelled out. 120 and 70. That gives me 190, 190 apiece. All things being equal, what do I have? 636, 648. Share capital for Pali, 400 because this has been cancelled out, this has been cancelled out. Apiece, Retained earnings pali, 100 apiece. What do I have? 500, 500. That give me equity attributable to the shareholders of pali. Second one is equity attributable to non-controlling interest, which in this case, I have it to be 36 for option A and 48 for option B. What do you have? 536, 548. What's my current liabilities? 80 and 20. And that give me 100. That give me 636 and 6 for what? 8. Does that make sense at all? Any question? Any question? An arrow?
No questions, understood.
Madam Anne.
No question, sir.
Madam Grace.
It's explicit, sir. I'm okay.
Madam Tomilayo.
It's clear, sir. I don't have any question.
Mr. Ayedele.
It's there.
Okay. Therefore, the next order we want to cross is this. The next order we want to cross is what happened to Goodwill subsequent to its recognition, as we have seen it here. What happened to Goodwill subsequent to recognition? Now, we've discussed Goodwill extensively. I'll share this note, and I want, I want Madam Anne to read this material with respect to Goodwill and impairment. First, let us go to the first issue about Goodwill. Okay. Okay. Over to you, ma.
Accounting for goodwill on consolidation. Goodwill represents the excess of the fair value of consideration, that is, the acquisition date fair value of the consideration transferred, plus the amount of any non-controlling interest in the acquiree, plus the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. Above, the investor's company pays a premium price for the investment in the investee company. And so can you bold it a little bit? It's quite tiny. I'm having difficulty in saying it. Okay, thank you. Above the acquisition date fair value of the identifiable asset acquired and liabilities assumed. Presumably, if an investor company pays a premium price for the investment in the investee company, it has seen values that transcend the worth of the tangible assets and intangible assets, or else the deal would not have been consummated on such terms. Empirical evidence have shown that goodwill arising from acquisitions, often traceable or consists largely of the synergies and economies of scale expected from combining the operations of the acquirer and the acquiree. IFRS 3 reverse requires that all goodwill arising from the business combination or purchase of a business or businesses should be recognized upon such acquisition as an asset. In a business combination in which the acquirer and the acquiree or its former owners exchange only equity interest, the acquisition date fair value of the acquiree's equity interest may be more reliably measurable than the acquisition date fair value of the acquirer's equity interest. If so, the acquirer shall determine the amount of goodwill by using the acquisition date fair value of the acquirer's equity interest instead of the acquisition date fair value of the equity interest transferred. To determine the amount of goodwill in a business combination in which no consideration is transferred, the acquirer shall use the acquisition date fair value of the acquirer's interest in the acquiree determined using a valuation technique in place of the acquisition date fair value of the consideration transferred. Technical note: IFRS 3 reverse requires the acquiree to recognize an increase or decrease in the provisional amount recognized for an identifiable asset or liability by means of a decrease or increase in goodwill. However, new information obtained during the measurement period may sometimes result in an adjustment to the provisional amount of more than one asset or liability. For example, the acquirer might have assumed a liability to pay damages related to an accident in one of the acquiree's facilities. Part or all of are covered by the acquiree's liability insurance policy. If the acquirer obtains new information during the measurement period about the acquisition date fair value of that liability, the adjustment to goodwill resulting from a change to the provisional amount recognized for the liability would be offset, that is in whole or in part, by a corresponding adjustment to goodwill resulting from a change to the provisional amount recognized for the claim receivable from the issuer. The calculation of the goodwill on the acquisition can be summarized below. Okay, the calculation of the goodwill on the acquisition can be summarized below. Partial methodology, all figures in million. Cost of combination, that is cost of acquisition to the parent, we have 100. Then we less parents 80% share of the fair value of subsidiaries identifiable net asset, which is 88. The difference will give us the positive goodwill, which is the partial goodwill attributable to the parent, which is 12 million. Then amount of investment invested in subsidiary to non-controlling interest, we have 30. Lessen non-controlling interest of 20% share of the fair value of subsidiaries net asset, we have 22. Then the difference between it is 8, which is also positive goodwill attributable to non-controlling interest. Then when you deduct, then the full goodwill, which is positive of 1 and 2, gives us 20 million. Measurement period. Should I continue, sir? Measurement period. Okay. Would that be all, or I should go on? Okay. Measurement period is the period.
Continue, yeah.
Okay. Measurement period is the period after the acquisition date during which the acquirer may adjust the provisional amounts recognized for a business combination. This period is not more than 12 months from the acquisition of the subsidiary or acquirer. That's all for the page.
Continue.
That's all for this page. It's finished. Page 95.
I've extended it now. I've opened 96.
I've not seen.
Can't you see it?
I'm yet. No, sir. I'm yet to see it.
What then are you saying?
I'm 95. The last page. I just okay. Okay. Alternatively, the positive goodwill arising from acquisition of a subsidiary can be ascertained as thus. Full methodology, everything in million. Cost of acquisition, cost of combination. So first we have cost of acquisition to the parent, that is the investment in the parent in subsidiary, 100 million. Amount of investment in subsidiary to NCI, which was measured as fair value, we have 30. Then the sum of it is 130. Then lessen the subsidiaries identifiable net assets as at the acquisition date. First, we have the share capital of subsidiary at 200, then pre-acquisition reserves at 10. Summing the two, we have 110, then netting it off from the 130, we have 20, which is the full goodwill. Technical note: the amount of NCI investment in the subsidiary as at the acquisition can either be measured, which is based on revised position of IFRS 3, as follows: 1, fair value, or 2, the present ownership instrument proportionate share in the recognized amount of the acquirer's identifiable net assets. In accordance with IFRS 3 revised business combinations, if the initial accounting for a business combination can be determined only provisionally by the end of the period in which the combination is effected, the acquirer shall, 1, account for the combination using those provisional values, and 2, recognizes any adjustment to those provisional values as a result of completing the initial accounting within the measurement period, which will not exceed 12 months of the acquisition date. Based on the IFRS 3 reverse, the group is viewed as an economic entity. This means that it treats all providers of equity, including NCI, are shareholders of the group, even when they are not shareholders of the parent. Thus, goodwill attributable to NCI needs to be recognized. The previous IFRS 3 method considers goodwill calculation from the point of view of the parent only. It only recognizes the goodwill acquired by the parent, and it is based on the parent's ownership interest rather than the goodwill controlled by the parent. It is not recognized under the former method, which is the old method. Furthermore, it is implied and taken as the benchmark treatment in measuring goodwill upon acquisition of the subsidiary. So, can you scroll up? Scroll up, please. Scroll up. I can't see something there.
I think your network is low. You scrolled up before.
No, scroll. Okay. Oh, wow. Okay.
Where did you stop?
Furthermore, it is implied that implied and taken as a benchmark. That's the furthermore, it is implied. There's something in bracket after the subsidiary. I can't see it, but I can see something like a parent, except I'll skip that. That's furthermore, it is implied and taken as a benchmark treatment in measuring goodwill on acquisition that the amount of non-controlling interest upon acquisition of the subsidiary, I assume that, or the parent, be measured at the proportionate share of the recognized amount of the acquiree. Okay, I can see it now. Let's stop. Okay. Furthermore, it is implied and taken as a benchmark treatment in measuring goodwill on acquisition that the amount of NCI upon acquisition of a subsidiary or by the parent be measured at the proportionate share of the recognized amount of the acquirees or subsidiaries' identifiable net assets. But an acquirer can elect otherwise by adopting the fair value measurement, and this must be applied consistently from the date of such adoption, usually at acquisition, which can no longer be reversed. The election is not generic, as it can be adopted on a one-on-one basis for the purchase of businesses that may have occurred. That is, if there are two or more business combinations that have taken place, the first business combination may have the choice of accounting for NCI different from the second business combination. The above scenario of goodwill calculation depicts that goodwill to the group on the acquisition of the subsidiary amounts to 20 million naira, of which 12 million naira is attributable to the parent and 8 million naira is attributable to the non-controlling interest. The goodwill attributable to the non-controlling interest is, next page, 97.
Can you see it?
Next page. Is that all?
Can you see it?
Okay. I'm here to see 97. I'm on page 96.
Okay. Can others see it?
Yes.
I think it's taking time lag for what's it called, Annie, to see it, because I think our network is poor. Can you see it now?
Not at all.
Okay, can somebody take it up from there? Nuruddin, can you take it up from there?
Okay. possible based on the fact that non-controlling interest investment was measured at the acquisition date fair value of 30 million. Otherwise, no goodwill will have been attributable to non-controlling interest if the amount of non-controlling interest is measured at the proportionate share of the recognized amount of the acquiree's identifiable net assets at acquisition. Whenever the investment of non-controlling interest is measured at proportionate share in the recognized amount of the acquiree's identifiable net assets at subsidiary acquisition by the parent, the amount of non-controlling interest equates the non-controlling share of the identifiable net asset, identifiable assets and liability of the subsidiary used in determining the goodwill. Hence, no amount of goodwill is arrived at with respect to non-controlling interest investments. It is as it is shown below. Cost of combination, i.e. cost of acquisition to the parent, 1 million, 100 million. Amount of investment in subsidiary to non-controlling interest, 20% of 110 million, which is equivalent to 20. Combined amount of interest in subsidiary to all investors, 122 million, less subsidiaries identifiable net assets as at acquisition date. Share capital of subsidiary, 100 million. Pre-acquisition reserve, 10 million. Total, 110 million. Subtract from combined amount of interest in subsidiary to all investors, equal to 12 million. Goodwill, partial goodwill, positive. Alternatively, the positive goodwill arising from acquisition of a subsidiary can be ascertained as thus: in million, cost of combination, i.e. cost of acquisition to the parent, 100 million. Amount of investment in subsidiary to non-controlling interest, 22 million. Combined amount of interest in subsidiary to all investors, 120 million. Less parent 80% share of the fair value of subsidiaries' identifiable net assets, that's 85 million. And non-controlling interest, 20% share of the fair value of subsidiary net assets, 25 million, the total 110 million. Subtracts from combined amount of interest in subsidiary to all investors, equal to 12 million. Goodwill, partial, positive. We consider a simple illustration below to display.
That's all. Thank you very much. Thank you very much. Now, that summarizes everything we have been discussing since morning about recognition of goodwill in consolidation. Now, what then do we want to do now is for us to go to what happens to goodwill subsequent to acquisition. What happened to goodwill subsequent to what? Acquisition. And that we are going to see that, which means the effect of goodwill after acquisition is to subject it to impairment test. That is where we are going to in this case. Okay. Now, goodwill is an asset that has an indefinite life. An indefinite life means that as of the moment, we don't have a reliable basis to estimating what is the useful life. Such a situation is called an indefinite life. Now, in that regard, goodwill, like any other asset that has an indefinite life, are not required to be subjected to any basis of cost allocation. which means they are not required to be subjected to either depreciation, amortization, depletion, whatsoever you call it. Why? Because for you to depreciate or allocate historical cost of an asset, you must have a basis which is tied to its useful life, in which case this does not have. Now, regardless of that, assets are still required to be subjected to impairment once there's evidence of impairment. But because goodwill, land, and similar assets like that have indefinite life, the provision of IS 36 borders on the fact that such assets should at least once every year should be subjected to impairment assessment, which then means that in this case, goodwill, though it's not subjected to any other basis of cost allocation, but must at least at every reporting date be subjected to impairment test. The question then is, what is impairment test? Impairment test is a methodology adopted to assets in order to determine whether such asset has its recoverable amount falling short of its carrying amount. What do we mean by recoverable amount? We mean that recoverable amount is what you can generate by way of economic benefit over the remaining life of an asset. You now compare it with what the asset is being carried for now. Wherever you have situation where the carrying amount is higher than the recoverable amount, it means such asset is unable to recover all of its carrying amount, and the shortfall in that is what we term as an impairment loss. Which means impairment loss invariably arose when the carrying amount of an asset is more than its recoverable amount, or when the recoverable amount falls short of the carrying amount. Now, later on when we get to our statistic, we'll see how goodwill is tested for impairment. Because goodwill is not an asset that generates cash flow independent of others. Therefore, it will be difficult and it will be impracticable to subject goodwill alone for an impairment test. Rather, you subject goodwill for impairment test along with other assets that falls within the cash generating units to which such a goodwill has been allocated. We'll discuss about that later under IS 36. But let's come back to this level now. This level, what we are saying is this. Let us assume that we have covered IS 36. Let us assume we know how to subject goodwill for impairment. Let us assume impairment loss has arisen from the test on goodwill. The question at this level, which is in line with IFRS 10, is how should impairment loss on goodwill be treated in consolidation? The question is, how should we treat impairment loss arising from goodwill in group accounts? And to treat it, the first question we ask is, which form of goodwill has been impaired? Remember, we have two forms of goodwill for the purpose of recognition. One, we have partial goodwill. Two, we have full goodwill. The question is, the goodwill that we are talking about that has suffered an impairment loss, is it a partial goodwill or is it a full goodwill? And let us see what happens in that regard. Let us look at this problem, and we'll use this problem to solve the issue. Can somebody read this question? Mr. Enauru, can you read this question? And let us try solving it. Mr. Enauru, I think he's not there. Okay, Akin Folarin, can you read the question?
Illustration 3. Pali acquired 80% of the equity share capital of SUSI at the reporting date of 31st December 2013, when the retained earnings of SUSI was 40 million. The statement of financial position of the two companies as at this reporting date of 31st December of 2015 is as follows. Pali and Suzy figures are in millions. Property, plant and equipment, PPE, 300,000 for Pali, 130 for Suzy. Pali investment in Suzy is 160. Current asset, Pali 120, Suzy 70. Total asset for Pali is 580 and total asset for Suzy is 200. Share capital and reserve. Share capital at ₦1 per share for Pali is 400. Equity share capital, same at ₦1 per share for Suzy is 120. Reserve, 100 for Pali, 60 for Suzy. Current liabilities, 80 for Pali and 20 for Suzy. Total equity and liability for Pali is 580 and total equity and liability for Suzy is 200. Assuming the prevailing market price of Suzy's share prior to the date of acquisition is ₦2 per share. In order to
continue.
In order to understand the concept of treatment of impairment losses on goodwill, we will approach the illustration earlier considering the above where the treatment of goodwill is showcased, and we are to assume that goodwill has since been impaired over time by 12 million.
Okay. Now we are reporting, we acquired on 31st December 2013.
Yes.
And we are reporting 2 years after, 2015. That is 2 years what? After. Reserves. Suzy's reserves as at today, 2015, if you check in the books, it is 60, which will split into pre, which is as at 2013, pre-acquisition, which stood at how much? 40 million. And post-acquisition profits of 20 million. Now, let us determine our goodwill. I'll try and combine the two together, A and B, because I want to measure NCI at proportionate share and at fair value so that we can see the implications. Cost of business combination. Pali's investment in Suzy. If you go back to the question here, it's 160. NCI, we have A and we have what? B. A is the proportionate share. And B is a fair value. X and what? Y. We compare that with the net assets of Suzy as at the date of acquisition. And that is made up of share capital and pre-acquisition reserves. What is the share capital? 120. What is the pre-acquisition reserve? 20. Sorry, 40. And that gives me 160. That gives me 160. Now, let me come over here. A says NCI is measured as proportionate share, which is 20% of net assets. And what is net assets? The net asset is 160 million. That should give me 32 million. Which means in that case, I'll substitute X, in this case, for 32 million. And that gives me 192. Hence, yeah, I can say my goodwill is 32. B says NCI is measured at acquisition date fair value. And that is based on market price. And the market price is 2 naira per share. 2 naira per share times number of shares NCI has in SUSI. And what's the number of shares? We are not given. But if you recall, out of this share capital of 120, we divide it by 1 naira per share, and we get 120 million shares, of which 20% of it is due to NCI, which means 20% of 120 million shares will give us 24 million shares. That is how we get 24 million shares, which I'll bring here. And that invariably gives me 48 million naira. That 48 million naira is what we substitute with Y. And say Y is 48 million. And that gives me 208. Minus that gives me 48 goodwill. Okay. Now, what is the major problem? The major problem is that we are told that goodwill has since been impaired by how much? By 12 million. When there's an impairment loss, on an asset, the implications are thus. 1, a reduction in the carrying amount of the asset. 2, a charge in the profits or loss as an expense. That's what it means. This is a general principle for impairment loss or any loss. Remember, from the conceptual framework, we discussed that a loss is an expense for financial reporting purposes. Therefore, what will I do? What will I do here is that in the bill to recognize impairment loss, the treatment will be as follows. Treatment of impairment loss or losses on goodwill. A, if it is a partial goodwill, though we have said we have to reduce the goodwill and we have to charge the loss to profit or loss. But the profit or loss we are charging it to is that of the subsidiary that carries the asset that has suffered the loss. But the next thing we need to ask is that the profit or loss of subsidiary is usually attributed to the shareholders, which is made up of the parent and the NCI. The question then is, who is the ultimate person that bonds such a loss? Is it all of the shareholders or is who? For a partial goodwill, it's not all of the shareholders because we have classified the shareholders into two. We have the parent and we have the NCI. Now, partial goodwill, if we go back to our discussion, partial goodwill is only when you decided to recognize goodwill of the parent alone. And which then means that if that is the case, you have only taken the interest of the parent alone. And where there's a loss, the parent also suffers it alone. That is what it means. Which means invariably, what do I do is to come back to say that such a loss would be charged, though, to the subsidiary's profit, but invariably, it is borne by the parents alone through a charge in his group what? Profit or reserves. And the corresponding credit would be to reduce the amount of goodwill. In this case, with the 12 million naira. But what can we say if it's full goodwill? If it's full goodwill, the treatment will be slightly different. How and why? If we go back here, we said full goodwill is a goodwill such that we recognize the parent alongside with NCI's contribution to the goodwill. Which then means that if such a goodwill have suffered the loss, since both parties contributed to it, those parties bonds the loss. And in that case, what happened is to recognize that those parties will both bear the loss. Both parties will bear the loss in the proportion to which they have agreed to share profit or loss. Which means the parent will take care of 80%, which goes to the group reserve. The NCI will bear 20%, which goes to the NCI's account, while the corresponding credits will all impart goodwill to the tune of 12 million. 80% of that approximately should give me 9.6 million. Why 20% of it should give me 2.4 million. Invariably, that is how we treat it. Which then means that here, I come here to recognize impairment loss. I think my marker is misbehaving. Okay. Okay, it's back. The impairment loss. Therefore, the impairment loss on Goodwill is 12 based on the first entry, which you have here. It's also 12 based on the option B. Invariably, what is our consolidated goodwill? Our consolidated goodwill will now be 20 after impairment and 36 after impairment. That is the treatment we accord it. Now, let us look at our NCI as at reporting date. A and B. NCI as at acquisition date. If you go back, our NCI at acquisition date is 32 and 48. Share of post-acquisition profit. We are taking 20% of 20 million. Can you see it here? That is 4. Now, impairment loss, which affect the parent reserve, is 12, which means less impairment losses on goodwill. Nothing here, because all is borne by the parent. Why 2.4 here? Because it is being shared. All in all, what do I have? I have 36 here. And I have 48 plus 4 minus 2.4. I have 49.6. Next. Consolidated reserve. As at reporting date, I have A, I have B. What is Pali's reserve? From the account, Pali's reserve is 100. And Pali's share of post-acquisition profits is 80% of this 20. That gives me 16. And also, we are aware that there's an impairment loss on goodwill. $12, which is this entire 12, belongs to the parent. And here, 9.6, based on the fact that he bought it alongside with NCI. Invariably, what do I have here? 104, 100 plus 16 minus 9.6, 106.4. Okay, that gives us our position. Therefore, what can we do? We want to show that position in our balance sheet. Therefore, let me copy this balance sheet here. Okay, let me try and clean it up. Okay, let's pick it one by one. Let me try and bring the question down. Okay, I have 300 plus 130. That's 430. After impairment of goodwill, the balance of goodwill for A is 20 and B is 36. $450 and $466. Current assets. This has cancelled out. Current asset is 120 and 70. 190. That should give us 640 and 656. Share capital pali. Why? Because this has been cancelled out. This has been cancelled out. What do you have? 400 apiece. Retained earnings is now as consolidated. 104 and 101.64. Now 6.4. That should give me 504 and 506.4 as my equity attributable to the shareholders of Pali. NCI, the value of my NCI is 36 for A and 49.6 for B. 36 and 49.6. That gives me 540, and this gives me 556. Current liabilities. I have 80 and 20. That gives me 100, which is 640 and 656 a piece. Okay, any question at this point? Any question at this point? Any question at this point?
Hello, sir. Hello.
Hello.
Yeah. Actually, my question is not based on the computation, but rather I want to actually know the reason, the period at which we can actually adopt proportionate, the basis of us measuring the non-controlling interest using proportionate share of identifiable net assets, when it is quite understood that the provision of IFRS even suggested that we should go by fair value option. I don't know if my question is.
What's your question? I'm not getting it. What's the question?
Okay, what I'm saying is that we have two methods of measuring non-controlling interest. Okay, but in practice, I know that
you are muted.
Okay, I know that most entities usually adopt fair value method for measuring their non-controlling interest.
How many entities have you seen in practice that have done that?
I used to go through the financial statements of some companies.
Okay. Which of them? So that we can go online to check it now. The reason is that fair value model was introduced in 2011.
Okay.
Okay. Is it not 2011, 2008 revision to the standard. Now, and those combinations that precede that date are majorly based on proportionate share.
Okay.
But those new acquisitions that take effect, that is when the option came into being. And mostly is a mix of fair value and proportionate share. But the question I think you are asking is, why do you worry doing proportionate share when you have fair value? Is that your question?
Exactly. That's where I'm heading to.
Yeah. Let me now put it to you in this analogy and simple question. Between jollof rice and fried rice, which one do you like or prefer?
No, you
have to be specific. If you go to a party and they say, we have jollof rice or fried rice, it's all, they are not mixing it. Which one will you take?
Okay, let me say fried rice.
Fried rice.
Yes.
Okay. Asama, which one will you take?
Okay, let me say jollof rice.
Okay, Asama, why do you pick jollof rice over fried rice?
No, it's just my choice. It's just my preference now.
Okay. Nuruddin, why do you pick fried rice?
It's my favorite.
Your favorite. Okay.
Yes.
One man's another man's poison. That answered the question. Once you have option, and the option is within what you can take, now the choice of it depends on the favorite position or the feeling or many other things that you cannot say why you go for this. It's the same thing in politics. Today, as a Nigerian, you must vote for a party. Somebody said, why will you vote for that party? Another person say, why do you vote for that party? You are seeing things from different angles. Therefore, in that manner, it depends on what other things give you more value, consideration, and other things. That is what forms your judgment. No method is better than the other. It's a choice.
Okay.
One thing about it is that any method you so choose, you must be able to follow it consistently. Does that answer your question?
Yes.
Okay. As time goes on, you see what are the pros and cons of each of those methodologies. Any other question before we call it a night or a day, as the case may be?
Another thing, Mr. Muyiwa. Hello?
Yeah, you can continue.
Another thing that I want to confirm is, does entity even usually measure the determine the impairments of their assets, if I should put it that way? Because I believe that most accountants,
assets,
I mean goodwill.
Yeah, did they testify impairment?
Yes.
Okay. Remember, I shared certain financial statements with you guys. Okay. What I'll do is that I'll share some financial statements of companies that qualify as a parent, which prepares group account. I'll share it with you guys, and probably you peruse it and you come back with your feedback, and we'll take it off from there.
Okay.
Does that make sense?
Yes.
I've shared the notes for today on your WhatsApp group. You pick it up from there, and before night, once the recording is completed, I'll share it with you. Thank you very much, and God bless you. We'll see you tomorrow, 2 p.m.